Three stocks, the January 2020 edition. Let's get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. As always, this monthly series is not a recommendation to buy or sell anything. That is not the purpose of this channel. You should always do your own research and make your own decisions. This is more of like a 3 stocks to watch kind of series, and it's just a fun way of me teaching you guys about 3 different stocks every month. And to make things more interesting, I try to categorize them into one low risk, one medium risk, and one high risk so that we have a wider range of stocks to look at every month. But if you want to see past episodes, make sure you check out the 3 stocks monthly playlist, which you can find up here down in the description or at the end of this video on a clickable card. But with all that said, let's go ahead and start with stock number 1, which is going to be our low risk stock for the month. And because the market is trading near record highs right now, at least here in the United States, I decided to go with a more trusted name in the market and one that doesn't normally see too many dips anyway, and that is of course MasterCard. Ticker symbol is MA, the digital payments processing giant. Now, as you guys know from previous videos, I'm actually a bigger fan of Visa myself, but it feels like we always talk about them on the channel, so this month we'll show some love to their little brother in MasterCard. And to be honest, I wouldn't really mind owning either one of these two great stocks. As I mentioned before, and just like Visa, MasterCard rarely dips, as they've now climbed by nearly 240% in just the past 5 years alone in what has been a pretty smooth looking uptrend chart. That's because their business performance has been outstanding through the years, with revenue growth consistently being in the teens and are expected to continue doing so even into the future. Revenue growth as a percentage, of course. Profits have been equally impressive though, with projected EPS growth of around 18% both this year and the next, with a 5-year average of about 17%. That is definitely not bad. Part of the reason why is because they consistently spend billions of dollars a year to buy back their own shares. As you can see on this chart here, that their outstanding share count continues to drop every single year. In fact, just earlier this month, they announced another $8 billion to continue buying back stock. But that's not the only way that MasterCard rewards its shareholders, as they are also a bit of a dividend growth stock, having just raised it again, this time by a whopping 21%. Now granted, the dividend is still very small at just around half a percentage point, but with a payout ratio of only 20% and a monstrous 5-year growth rate of nearly 37%, I'd say that it's not only sustainable but also very likely to keep growing at some very high rates into the foreseeable future. Now, the growth history isn't very large at only 8 consecutive years, but from my understanding, I believe they've paid a dividend since 2006 without ever cutting it, even during the Great Recession. So that leaves me feeling pretty confident about them as a long-term dividend growth stock. And that's especially the case when you consider the strength of their business. As a digital payments processor, MasterCard doesn't really have to take on the same risks of lending out money like banks do. Instead, they just collect a fee every time a transaction is made on their network. This is accounted for in what we call total payments volume, and over the past 12 months, MasterCard actually saw much higher growth than even Visa, and by a fairly large amount. Part of the reason why is because much of the growth that is untapped by so many US companies is, well, outside of the United States. And when looking at which company has more of their business reliant on the global market, MasterCard far surpasses Visa, with about 70% of their volume coming from outside the US, while Visa's is much lower at just 54%. So MasterCard is kind of a bigger play on international markets, while Visa is a bigger play here in the United States. But this is a big deal because those international investments seem to be paying off for MasterCard, as their international growth was higher than domestic at 16% internationally versus a smaller 12% growth in the US in their last quarter. Now, all of this growth doesn't come cheap, as they actually trade for a higher price than Visa when looking at forward earnings, which is another reason why I actually prefer to own Visa stock myself, but they're still only slightly higher than the sector median, and it could definitely be argued that MasterCard deserves to trade for a much higher premium than sector averages when you consider their growth. And keep in mind that there's plenty of reasons still to expect that growth to continue in the future, such as the rise of online shopping, the decline in physical cash use, and a potential trade deal with China that grants better access to the Chinese market for some of these US financial companies. Still, you guys know that I like to do most of my buying when stocks are going down, not so much when they're going up. So right now, MasterCard does seem like it might be a little bit out of reach for me at the moment, and I still kind of like Visa a little bit more because of their greater dominance and their cheaper valuation. But considering that these stocks rarely dip, it may still be worth picking up like a small position in MasterCard and then just kind of adding to it over time, especially when there's a correction in the market, and then using that opportunity to buy much heavier and lower your cost basis by a significant amount. Long term though, MasterCard looks like a really solid company and one that I expect to perform very well into the future, and they're doing so already, and I expect that to continue. Okay, now because the market is so high right now, I purposely chose the next two stocks as two very high growth companies that have actually seen their stocks get crushed recently, making them much more interesting, but they have a lot of added risk. So that's sort of the trade-off that you have to take with these two. And honestly, I'm not exactly sure which one has more risk than the other. So for the medium risk, for stock number 2, medium risk, I'm just going to go with the one that I know a little bit more about, that I feel a little more comfortable about their company and their business and their products, because I actually buy some of their products myself. And that company is, of course, Funko. Ticker symbol is FNKO, which is a sort of toy maker. And we actually talked about them not too long ago in a previous video, but I've been researching them more lately because I do find them very interesting. Now, they sell all kinds of different licensed merchandise from popular brands like Star Wars, Marvel, and DC, but also hit TV shows like The Office or Stranger Things, and even sports teams as well. And their most popular products are these Funko Pop figures that me and my friends actually buy sometimes and use them as trophies for video game tournaments that we create, or just any other sort of challenge where we need a prize. But they're also just really cool as decorations or to show off what type of things you're a big fan of. And so far, their products have sold like hotcakes. In fact, their Baby Yoda Pop quickly sold out after release, and Funko has been really working hard to replenish stores as fast as they can ever since. This can ultimately leave them with a bit of a cyclical business though that can sometimes swing up or down depending on the market and how much certain brands are trending. Still, because Funko is a fairly new company that barely IPO'd only a few years ago, sales have mostly been climbing by very high rates over the years, with revenue growth even topping 30% last year before returning to a more normal level of 23% this year, and that's expected to slow down even more to just 11% the year after. That's ultimately led to investors fleeing the stock as they're worried that growth in the collectibles market is not sustainable. Don't get me wrong, the stock is still up by over 130% over the past 3 years, which was around the time that they IPO'd, but it's mostly been a very volatile ride, and they once soared all the way to over $30 a share in 2018, then crashed and lost over half of their value towards the start of 2019 before quickly recovering to once again reach close to that $30 range, only to fall yet again to now trading for just around 16 bucks a share. Over the long term though, this may end up being one of those bottoms that was considered a buying opportunity if their business proves to be more sustainable than Wall Street predicts. And I'll just quickly give you 3 short reasons why that may actually end up being the case. Number 1 is that their products are very cheap to make, and that's led to them actually being a profitable company despite their young age and how much they reinvest into the business to keep growing. In fact, they have a forward P ratio of only 11.5. For context, other toy companies like Mattel and Hasbro trade much higher at over 105 and over 22 respectively. Granted, those are obviously much larger companies with different business models, and Hasbro also pays a very attractive dividend too. But when looking at the broader sector, Funko still trades about 40% cheaper than the sector median on a forward P basis and close to 60% cheaper on a PEG basis. So not only are they profitable, but the valuation is also more than reasonable. Number 2 is that their investments overseas are paying off as they continue to expand to more retailers and acquire more shelf space, which may prove to be a great way of sustaining their growth in in the coming years. In fact, international sales made up 32% of total revenue last year, which was up from 27% the year before. And those sales also grew by a massive 57% with double-digit growth in literally every international market that they operate in. And finally, reason number 3 is that their business is a lot more diverse than people think it is. Now, they assume that their consumer base is just like a bunch of nerdy boys that only buy the newest trends and therefore sales will eventually tank, but the reality is that their consumer base is actually 51% female, with the average age being 35 years old, and the entire pool is split up almost perfectly even into 3 categories of occasional buyers, enthusiasts, and collectors. That's led to nearly half of all of their total sales actually coming from evergreen products, which are older brands rather than like current movies, shows, or anything else. In fact, no single property even made up more than 6% of their total revenue. In other words, a huge portion of their business is not even reliant on what's hot in the market right now. But even if it was, I don't necessarily think that that's a bad thing. The way I see it, it almost ensures that people will buy their products, because as soon as a cooler brand or movie or show or whatever else comes onto the scene, Funko can target that audience and profit heavily from it. And I also think that that's not something that is very easy for Wall Street to be predicting in the future. But that also leads me to think that the stock will probably continue being volatile in the future because of their sort of unpredictable nature of their business. And this deep in our economic cycle, I'm just focusing a little bit more on more predictable, more stable stocks, especially those that pay dividends. So I probably won't be adding Funko right now, but if it keeps falling, I may actually pick up a small position myself because I do kind of like them. All right, guys, moving on to stock number 3. It's supposed to be our high risk, but I don't know, I kind of compare them similarly to Funko. But for this one, I decided to go with a very high growth online clothing retail company that barely IPO'd about halfway through 2019. So a fairly new one that people have been kind of looking into. And that's, of course, Revolve. Ticker symbol is RVLV. Now, taking a look at their stock, we can see that they IPO'd back in June, and the stock quickly climbed to nearly $50 a share, but later proceeded to crash all the way down to just $18 a share. That's a drop of over 60%. But the interesting thing is that their business is actually doing very well, with sales growth of 25% last year and projections of 21% growth this year and 22% the following year as well. And even profits are pretty strong, with projected EPS growth of double-digit rates both in 2020 and over the next 5 years on average. And so that, coupled with the drop in share price, has left them with a PEG ratio that is about 14% cheaper than the sector median, even though their current PE ratio is still pretty high. But keep in mind that last quarter net income climbed by 34%, adjusted EBITDA soared by 40%, and operating and free cash flow both grew by 4 times the amount year over year. That's pretty significant. And because Revolve sells all of their clothing, footwear, and accessories online, they've been able to grow at very high rates at a time when most traditional brick and mortar retailers are either struggling real heavily or even going bankrupt. It's also because Revolve has done a great job of attracting young shoppers to their platform by using a very effective advertising or kind of marketing strategy that involves thousands of influencers across some of the most popular social media platforms like Instagram. The result has been a growing number of active customers in every single quarter for years, with 33% growth last quarter alone. And the interesting thing is that there's still plenty of room for more growth in the future, considering that online retail in the US is expected to soar from over $500 billion last year to nearly $750 billion by 2023, yet it still only made up about 10% of all retail last year. But the opportunities don't just stop in the United States, as Revolve is also expanding into international markets as well, like China, Europe, and Australia, yet those international markets still made up only less than 20% of their total revenue, so there should still be further room for growth there as well. But why then has the stock been crashing by so much? Well, like any IPO, there's usually a very bumpy ride after IPOing, filled with a lot of early investors or even insiders selling out of the stock. And the problem for Revolve was that this negative momentum was fueled even further by two disappointing quarters that followed. In fact, they actually posted a loss in the second quarter that really scared investors, even though it was a one-time charge related to corporate conversions by repurchasing shares. I know that sounds a little confusing, but the point is that without those one-time charges, they were actually still profitable, although they were about 1 cent shy of EPS in relation to analyst estimates, and the stock proceeded to crash by over 20% in just a couple days as a result. Then in Q3, they returned to profitability and reported a monstrously strong quarter, but weaker guidance and high inventory levels that can hurt their margins led to the stock crashing even further as investors worried that the growth may be kind of coming to a halt in the future. In my opinion, though, I think a lot of this was probably overdone, as this is clearly a clothing retailer that is actually performing very well at a time when several others are struggling. And I actually think that for what you get in return, the price right here does look very attractive, but there's still two main reasons why I just can't bring myself to buy the stock, at least not yet. Reason number one is that I just really have no experience in the women's fashion industry. It's not a market that I'm very interested in, and I obviously don't buy any of their products, so it's difficult for me to understand the company and their products and their competition, and all of that goes against my investing principles, which is to really understand the company before I'm willing to buy the stock. And speaking about their competition, that brings me to reason number two, which is that I'm not exactly sure what Revolve's moat or their competitive advantages over the competition that they can't replicate at some point in the future. Again, to understand that, I would really need to be more familiar with the company, the market, and the competitors to really know what sets Revolve apart and what will continue to set them apart in the future. Right now, it looks like I don't know, I guess maybe they have a first movers kind of advantage. They have a really great marketing strategy, and all of that seems to be working, but I'm just not sure why other companies can't replicate it in the future and hurt Revolve's sales. So that's another concern for me. So I do really like this stock. I would love to pick them up, but I would have to do a little more research before I'm feeling comfortable with investing long-term in this company. So anyway, those are my thoughts. What do you guys think about these three stocks that I talked about in today's video? Do any of them catch your attention? Are you invested in any of them, or are you thinking about investing in any of them? Or do you think that they're all just like horrible stocks? I would love to hear your thoughts down below in the comment section. Thanks again for watching. It really means a lot to me. And if you enjoyed the video, please consider hitting the like button. It really helps support the channel. But I'll catch you guys in the next one. Take care. Bye-bye.